All right. So we've said this before. As interest rates go up, the value of your bonds go down. And Bloomberg says that bonds with maturities of 10 years or more are right now experiencing being down 46%. If you have a 30-year bond, it's down 53%. So if you look at those two numbers, it's like the bond market is experiencing its own 2008. And if you've got that classic 60-40 portfolio, 40% of the money that you have in that 401k or that IRA is experiencing a 2008. What are you doing? Okay, Greg, you talked about it a little bit earlier. Bonds are not doing well right now. People are sifting, moving their way out of that to other places with interest rates. What do we do if we look in there right now and you do an analysis and you find 60-40, 40% is in bonds?
We got to see what are they in actual bonds or are they in bond mutual funds?
Okay.
Bond mutual funds are evil, right? I mean, at the end of the day, that's the problem. They're very, they have to sell and buy positions in their mutual fund, and that requires them to be more liquid, which then decreases the value of the fund because you have to ride with the interest rates. When people say their bond value's down, I want to make sure the users at home, or I'm sorry, the listeners at home understand what that means. When you buy a 10-year bond, and let's say that they say it's down 43%. Unlike a stock, you're guaranteed to get everything out of your bond that they promised you if you hold on to it the entire time.
Okay.
And it means when you own an actual bond, the coupons and all of that fun stuff, like it will never go backwards in value if you hold it till the end of maturity. You'll get exactly what you paid for.
Mm-hmm.
When bond values go down, it's because they're actively traded. So like as interest rates go up, bond values go down. As interest rates go down, bond values go up. And the reason's obvious, right? You can get better interest rates. It's going to decrease the value. It's going to be hard to sell a 3% bond if the market's giving you 5%.
Right.
If you're locked in for 10 years. So that's the first part I want to make sure that, listeners understand is that, it makes something very illiquid. So hopefully you're not in a bond mutual fund. The problem, people wanted safety. So people like Fisher and Edelman and Eddie and Ray and all those guys, Merrill Morgan. So they sold bond mutual funds purely because they didn't want to go through the work of actually trading bonds, first of all, because it's complicated and it's expensive. And two, they can keep charging 1%. So if you got a bond mutual fund, you should be angry because there's a lot better ways. If you're in bonds, you should have someone that knows how to ladder bonds, and you should own actual municipalities or actual corporate bonds, whatever the poison is that you think makes sense for your plan. If you're going to buy bonds, stay out of the mutual. It's the opposite of stocks when it comes to mutual funds. It doesn't make sense, to jump into that market, and that's a sad part that we see a lot of people falling that trap because it's easier, it's faster.
Mm-hmm.
For that financial advisor just to hit a button for, oh, this is a bond mutual fund. You get to be diversified. No, you don't. You get to be illiquid, and they not have to buy and sell bonds all the time, regardless of where the interest rate's at. Whereas if you buy a municipal bond in your local city, you're just going to hang on to it until maturity, right?
Mm-hmm.
So if you have a buy and hold and you have money that you don't care and you get a pretty good coupon rate, sure, bonds still make sense if you know that if you don't need it. If you don't need it. And I think that's some people that, I don't know, I might need it. Well, in this interest rate market, bonds are dangerous because, as you just said, Randy, 43% down.
Yeah.
So if you need to cash some out, you could be taking a 40, 50% haircut. That's scary, especially if the bond, interest rates keep going up. Now, what's the alternative? We always talk about, you've heard money markets, you've heard CDs, we've heard us talk about annuities. Annuities have a lot more liquidity than bonds and CDs. And that's why we like them. You can usually almost all of them universally allow at least 10% draws a year at no risk. So that means if you put $1 million in, you get $100,000 out if you need it every year with no risk. It also has a tax deferred growth. Obviously municipal bonds are tax free, so that's nice, but you can't, you have liquidity issues depending on how long. But with annuities, you can actually time it up and say, all right, you know what? If at most case I'll need, $100,000 a year out of this one account that I'm going to put, but it grows tax deferred, Randy. So unlike a CD that you're getting a 1099 every year and paying tax, you're getting interest on interest before you have to pay it. So annuities, it's another win for why they make sense for certain circumstances.